If you own a home, then you need to be fully aware of all the taxes that you're required to pay to the government. Otherwise, you could be taken by surprise and end up owing far more than you thought. Today, I'll explain to you all the taxes that homeowners are subject to for their properties. I'll also break down key deductions for homeowners. Considering the fact that roughly 2/3 of all United States households are owned by their occupants, this video is going to be extremely relevant for the majority of American populations. Let's dive in. Property taxes are the primary tax burden for homeowners in the United States. They're levied by local governments such as counties, cities, or school districts, and they help fund essential services like schools, roads, and public safety. These taxes are based on the assessed value of the home and land. Property taxes vary widely by location, typically averaging around 1% of the property's value, but ranging from 0.5% in low tax areas upwards to over 2% in high tax states like New Jersey and Illinois. Homeowners often pay these taxes annually or semi-annually, and these taxes are frequently paid through monthly mortgage payments. States like California cap property tax increases under Proposition 13, while exemptions such as the homestead exemption or senior discounts may reduce the tax burden in some areas. But to give you an idea of how much property taxes impact the average homeowner, let's take a look at some of the numbers. In 2025, the median home price in America was $416,900. Since the average property tax rate in the United States is around 1%, we can calculate the average property taxes paid by homeowners in the US by multiplying $416,900 by 1%. When we do this, we get $4,169. So, on average, that is what homeowners are paying every single year for property taxes in the United States. Many people do not like property taxes because they can feel almost like rent payments to the government, which acts like a landlord. Not all countries and territories have property taxes. For example, the Cayman Islands, Fiji, and Malta do not levy property taxes. Just imagine how nice it would be to own rental real estate without having to pay the government property taxes. Maybe one day that will happen in America. But let's move on to number 2, capital gains taxes. When selling a home for a profit, homeowners may owe capital gains taxes on the profit, which is the difference between the sales price and the original purchase price. So let's say, for example, you purchased a home for $500,000 and you sell it 8 years later for $1 million. Your capital gain would be $500,000. However, the IRS offers a significant tax exclusion for primary residences. So, if you live in the home as your primary residence for at least 2 out of the last 5 years of ownership, you can exclude up to $250,000 of the capital gain from taxation if you're single. Now, if you're married, this goes to $500,000 when filing a joint tax return. Some states impose their own capital gains taxes, with rules differing by jurisdiction. Always consult local regulations and tax professionals when selling a property to understand the obligations. Now, when it comes to capital gains taxes, it's extremely relevant to determine whether your capital gains are short-term or long-term. Short-term capital gains are taxed at ordinary income tax rates, so they're taxed at the same rates as income from a W-2 job or a 1099 business. This can go as high as 37%. Short-term capital gains are capital gains for assets that are held for less than 1 year. For long-term capital gains tax rates, the tax treatment is generally better. So, if you hold your property for more than 1 year before selling, you can face significantly lower capital gains tax rates. In certain areas, homeowners pay transfer taxes when buying or selling a property, calculated as a percentage of the sales price. This typically ranges between 0.1% all the way up to 2%. These taxes, which fund local government operations, they're not universal. In fact, states like Texas and Florida often don't impose them, while other states like New York and California may have significant rates depending on the city or county you live in. The responsibility for paying transfer taxes may fall on the buyer, the seller, or both, depending on local customs and negotiations during the sale. What about special assessment taxes? Special assessment taxes are additional taxes imposed by local governments to cover the cost of specific improvements, such as new sidewalks, sewer systems, or street lighting, that directly benefit the property. See, these changes are typically one-time or short-term and are added to the homeowner's property tax bill. Go figure. The amount varies based on the project's cost and the property's share of the benefit, and homeowners may have the option to pay them in full or over time, just depending on local policies. Let's talk about the mansion tax. A mansion tax is a one-time real estate transfer tax for mansions levied in certain states, including New York, of course, New Jersey, Vermont, Connecticut, Hawaii, Hawaii, and Washington, as well as the District of Columbia. This tax applies to the purchase of high-valued properties sold above a specific price threshold, such as a $1 million or $3 million, depending on the jurisdiction. Now, this tax is calculated as a percentage of the property's sales price, often ranging from 1% upwards to 4% or higher, and it's generally paid by the buyer at closing. Although local laws or negotiations may shift the responsibility to the seller in some cases, the mansion tax is designed to generate significant revenue for state and local governments, often to fund public services like education, infrastructure, or affordable housing programs. And it typically applies progressively, with higher rates imposed on more expensive properties to reflect the greater value. Purchasing a high-value property in one of the aforementioned states or the District of Columbia, where thresholds and rates vary. What about some key deductions and benefits for homeowners? Let's talk about that next. Now that we talked about 5 types of taxes for homeowners, let's talk about some of the key deductions and benefits that homeowners need to know as well. The mortgage interest deduction. This deduction lets homeowners subtract the interest they pay on their mortgage from their taxable income, but only if they choose to itemize their deductions on their tax return instead of taking the standard deduction. It applies mortgages up to $750,000 for married couples or $375,000 for singles for homes bought after December 15th, 2017. It applies to primary residences and secondary residences. So itemizing is worth it if your total deductions, like mortgage interest, exceed the standard deduction, so it lowers your taxes based on your tax bracket. For example, if you pay $20,000 in mortgage interest and you itemize, you could save $4,400 in taxes at a 22% tax rate, assuming your deductions surpass the 2025 standard deduction of $15,750 for singles or $31,500 if you're married filing joint. Now, to maximize savings, keep accurate records of your mortgage interest payments, and please, as always, consult a tax professional to determine if itemizing is the best choice for your financial position. You can change from itemizing to taking the standard deduction year over year. Next is the state and local tax deduction. The SALT deduction lets homeowners subtract state and local taxes like property taxes and state taxes or sales taxes from their federal taxable income, but only if they itemize deductions instead of taking the standard deduction. The Big Beautiful Bill of 2025 raised the SALT deduction cap from $10,000 to $40,000 from 2025 all the way till 2029 for homeowners with income below $500,000, with the cap growing 1% each year before dropping back down to $10,000 in 2030. For those with incomes over $500,000, the deduction phases out, dropping back down to the level of $10,000. The SALT deduction helps homeowners in high tax states like California and New York actually save money when they file their returns. For example, if you pay $18,000 in property taxes and you itemize, you could save around $5,000 at a 28% tax rate, as long as your total deductions beat the 2025 standard deduction. We talked about this. The standard deduction is now $15,750 for singles or $31,500 for married couples. What about home improvements, such as adding a new roof, replacing the roof, paving a driveway, or adding new siding? Can this lower your taxes? Absolutely. And it can lower your taxes when you sell your home. This is because they can increase your cost basis. The cost basis is the original purchase price plus the cost of these major upgrades. By keeping detailed records of these improvements, you can reduce your taxable capital gain, which is the difference between the sales price and your adjusted cost basis. If you add your home improvements to your cost basis, it could potentially save you thousands in federal capital gains taxes because you're raising your cost basis and you pay capital gains on whatever is left over after you subtract your gain minus your cost basis. That is your capital gain that you pay taxes on. So, for example, if you bought a home for $300,000 and you spent $50,000 on a kitchen renovation and later sold it for $400,000, your taxable gain would be $50K instead of $100,000. This would lower your tax bill significantly if you didn't already qualify for exemptions like the $250,000 exclusion or the $500,000 primary residence exclusion that we talked about early on in this video. That's it for today's video. As always, don't forget to like, comment, and subscribe to our channel. I'll catch you up in the next video. Thank you so much for joining this one. I'll see you on the next one. Cheers.